It's that time of the year where investors look to the past and speculate about the future. So joining us for more on this is Martin Cobb, Senior Vice President at Equities at Lorne Steinberg Wealth Management. It's good to have you join us. Thanks so much and Happy New Year.
Yeah, good afternoon, Lindsay, and Happy New Year to you.
So before we look ahead to 2026, even though we're in 2026, just a quick recap on what you saw in the equity markets over the last year or so.
I mean, what a year!
Yeah.
What a year for equity investors around the world, particularly so here in Canada. I remember I remember the date because it was at Rabbie Burns, 25th of January. I had some neighbours round for dinner, and they were so scared about Canada, about investing generally in equities. And who would have thought? TSX up some 30% year to date. The relative laggard of the S&P 500 still up, over 15%. Year to date. Great year for equities around the world, despite all the noise.
I know it's been pretty wild to see how things played out, especially as you say, there was so much concern, so much worry, particularly in April, when really that tariff and trade talk started to get going. Do you expect to see the same kind of thing, the same kind of broadening out in 2026, or do you think things might moderate a little bit?
Yeah, unfortunately, I don't have the crystal ball. Otherwise, I would have retired.
Yeah, it's a guess.
Some time ago. And so, I think this is a really interesting time because, my inbox gets filled with, expectations for the year. And I think as Warren Buffett said, forecasts tell you more about the forecaster than they do the future. So any forecasts I make, I would take with a big pinch of salt. But, you're looking at the market, there were tentative signs that the performance, which has been heavily concentrated over the last couple of years, was starting to broaden out somewhat. I think we've seen tariff fatigue. I think the fact is there was so much noise, almost regardless now what happens with tariffs, almost regardless. We just got used to it. We're just getting on, doing our business, investing accordingly, etc. So I think the difference between now and maybe a year ago is starting valuations, both in Canada and south of the border, at an aggregate level, are fairly expensive. And whilst, short-term, performance of the stock markets pay no attention to valuations, it is more difficult to find attractively valued, high-quality businesses today.
And we're going to get to some of those in just a moment, but I just wanted to pick up on you talking about tariff fatigue. There's been so much noise around tariffs, so much back and forth. Do you think that that's one of the key lessons that investors maybe learned from as we head into 2026, or are there other lessons that you think investors picked up on?
I think that's a very good point. Is it a lesson that we've learned? I think investors learn an awful lot in the short term and then tend to forget that over time. In the long term, their memories aren't quite so good. I think it's just the fact that we saw so much noise. We still have a position today where the vast majority of our exports to south of the border are covered by, the new NAFTA, CUSMA. We are going to be seeing in July some sort of, renegotiation of that. It's being reviewed, as we know, to some extent. I wonder if the best thing that's possibly happening is just the whole talk about affordability in the US. We saw today that, some of the planned tariffs for furniture, cabinetry makers, etc., have been delayed. You're hearing lots of noises about the cost of living. Is that going to play a part, hopefully, in just calming things down to some extent? Because as I said before on the show, tariffs are a tax on the US consumer, an import tax effectively that is being applied quite broadly. Yes, it affects trading partners, here, there and everywhere. But ultimately, I think the pain is starting to be felt. We're coming into a year now of the midterms. Republicans are starting to worry. Perhaps things will just calm down a little bit.
Yeah, it's going to be interesting to see just how the American economy fares over the next year or so. Before we get to your two stock picks today, because of course I do want to get to those, I just wanted to say you have a bit of a quote here where you see pockets of pessimism that can present opportunities. What does that, I know what that means, but what pockets of pessimism are you talking about here?
Yeah, where is nobody talking about? Pessimism or apathy. John Templeton always talked about the best time to buy was the point of maximum pessimism. Really hard to do because, the noise around that particular stock, the narrative around that particular industry, might be terrible. I like to look for just, where's nobody talking about, what's not hot, and you can find there's always areas, whether it be sectors in the market or certain geographies. We've seen how well non-US stocks have done, last year relative to the US, which is the first time we've seen that for several years. There's some really high quality businesses out there that no one talks about, and that can lead to opportunities. And they don't have to be in the AI space. We can get away from that as investors. We've got thousands of stocks to choose from. Sometimes it feels we've only got 7 because that's all we talk about.
All right. With that in mind, we'll get to some of your picks for today, Martin. The first one is Adobe. Tell us what you like about Adobe as we head into 2026.
Well, I'm a numbers guy. And if you look at Adobe by the numbers, you would say this continues to be a great business. But there's a prevailing narrative out there, and that narrative is that AI is going to eat software, all software everywhere. Interestingly, there's a narrative about 9 months ago that large language models are going to eat search, Alphabet, which was on one of the cheapest valuations that we've seen. As to show that it isn't the case. And I think the case very much is the same with Adobe. It has obviously the Creative Cloud products. And I can go on now to Sora or various other models and create images and text, etc., videos even nowadays. But I'm not cancelling my Adobe Creative Cloud software subscription because I'm not part of that. Indeed, over 10,000 people sign up for their Creative Cloud subscription product every single day. They continue to deliver something like 10% revenue growth, very high free cash flow margins. But because of that narrative, they're trading on about 15 times this year's earnings. Historically, you paid over 30 times for Adobe. To me, that risk reward is really compelling.
Just lastly, in our last minute here, the next one is Tektronic. You mentioned that they had a bit of a slowdown after COVID, but now maybe a rebound?
Yes, they own Milwaukee and Ryobi, power tools business, market leader, been taking market share, long-term growth, obviously great pandemic, bit of a hangover, coming back today, enjoying sort of high single-digit, close to double-digit revenue growth, even better on an earnings per share level. Great market leader, long-term growth, and again, valuation not dissimilar to Adobe's, 15 times earnings. What's not to like?
Okay, very good. Martin Cobb, Senior Vice President, Equities at Lorne Steinberg Wealth Management. Really appreciate you joining us today. Thanks so much and Happy New Year.
Thanks, Lindsay. Happy New Year again.